Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks mostly seeing gains here on Monday, while investors are at the ready for a pivotal Fed Reserve meeting later this week, plus U.S. and China trade talks unfolding with some positive results. We're going to dig into those stories later. Right now, there's just an hour to go until the closing bell. Let's take a look at the major averages here. The Dow is roughly flat right now. The S&P 500, your broad gauge, is up about 0.4%. Your tech-heavy NASDAQ is up about 0.7%. Let's welcome in Fed correspondent Jennifer Schonberger. Got data and markets editor Jared Blickery to break down all the headlines. Jared, my friend, we will start off with you on the trading action so far today.
We have a rally in the mega caps, and that's being expressed through the NASDAQ. You're looking at the Dow right now, up a whopping 23, 24 points, or just 5 basis points. I will show you the price action intraday here, a little red, little green, and we are kind of oscillating around the unchanged, or the unch as they call it. But the NASDAQ is a different picture, a little bit off of those highs, but still posting gains of about 0.75%. And the S&P 500, about half of that performance, 37 basis points, and very similar chart. And I will show you too, the Russell 2000, small caps are slightly in the green here, up about 0.25%. And got to show you what's going on in the bond market. The 10-year T-note yield ticking down 2 basis points to 4.04%, approaching that big 4.0% psychological level. And the 30-year down another 2 basis points to 4.66%. Dollar following suit, just down about marginally. And let's skip over to the price action in the sectors. And let's see here. We are seeing, I mentioned the mega caps were leading today. You can really see this when you look at the 3 leaders. XLC is communication services. That is an Alphabet story. Consumer discretionary, that is a Tesla story. Sometimes Amazon. And tech, well, that's chip stocks and the software companies that we know and love. Also industrials and utilities outperforming and also in the green. Not working today very well are some of the defensive sectors. XLP, I just circled it, that's down about 1%. And then healthcare off about 0.8, and materials down about 0.7%. Now let's take a look inside the NASDAQ 100. I did mention Alphabet. This stock has been on a tear. Worth checking out a 1-month chart. You can see it's up 22% there. NVIDIA down just slightly today, but Amazon and Meta, Broadcom, each of those up more than 1%, and Tesla had been up 5%, up about half of that right now. If we take a peek inside the software industry within tech, we see a lot of green here. Some days we haven't seen as much green as we have in the semiconductors, but pretty balanced today. If you take a look at the semis, also a lot of green here as well. So overall, large cap kind of dominating today, but also some of the smaller caps, at least they're positive.
And from Wall Street to Washington, the Fed is on the verge of its first cut for 2025. The question remains, though, will it keep going, and how will markets continue to react? Jennifer, what are you watching out for ahead of Wednesday?
Yeah, Josh, that is the major question on the table. The Fed widely expected to trim its benchmark interest rate by 25 basis points come Wednesday afternoon. But the bigger question is, how many more cuts will Fed officials pencil in for the remainder of the year? Will it be one more cut, which would be exactly kind of where they were in June, 2 cuts for this year? Or will they pencil in more than that, perhaps an additional cut for a total of 3 cuts, which would be a cut at every single meeting for the remainder of this year? And I think a lot of that is going to hinge on the outlook for the job market, juxtaposed with the outlook for inflation. Inflation right now is about a full percentage point above the Fed's 2% target. At the same time, job growth has weakened over the summer months. In fact, it turned negative in the month of June, and as of the month of August, we are now below the level of job creation needed to keep up with population growth, even factoring in immigration. So the Fed is trying to balance both sides of its dual mandate. The other thing I'm looking for is, what are the economic projections? Has the Fed changed its projection for GDP growth, inflation, and unemployment? Frankly, I don't expect any major changes there. Still expecting sort of slower growth, modestly higher unemployment, which is what we're seeing, and inflation around the 3% level that we have right now. And the third thing I'm looking for is whether we will see any dissents. Stephen Miran, President Trump's nominee to the Fed, who is replacing Fed Governor Adriana Kugler, is expected to be confirmed by the Senate this evening. And we know that he has been very dovish. So the question is, if the Fed proceeds forth with the expected 25 basis point rate cut, will that be enough for Miran, or will he dissent because he would have wanted to cut by a larger chunk, perhaps 50 or even more. The same question on the table for Fed Governor Chris Waller, who said he was reserving judgment ahead of the August jobs report. He had said that if we see a deterioration in the job market, and was a 22,000 payroll growth for the month of August enough for him to want to cut by 50? Could we see a dissent from him as well? Bowman may be another. And by the way, we have not seen a dissent from 3 Fed governors since 1988. I'm not saying that's going to happen, but certainly something I'm watching for. Josh? For sure. Jen, thank you. Jared, thank you. As investors look ahead to the Fed's rate decision, we're taking a look at the market action with Gunit Dhingra, BNP Paribas head of U.S. rates strategy, along with Dory Wiley, Commerce Street Holdings CEO. Welcome, gentlemen. Gunit, I will start with you. So it feels like, Gunit, investors have decided, earnings are solid, the economy's hanging in there. That rate cut this week is a lock. I think, though, as our correspondent Jennifer Schonberger was noting, the focus for investors, though, really is this question: what is the pace of cuts going to look like from here, Gunit? I'm wondering what you have penciled in.
Yeah, thanks for having me on, Josh. We think the Fed is going to cut 25 in September, of course, but also follow that up with 25 in October and 25 in December, and 2 more rate cuts at some point in the first half of next year. We think the markets have been looking for perhaps a little bit more. A lot of investors are still looking for a bit more aggressive pace of easing. So even if the market feels perfectly priced right now for about 3 cuts this year, I think it's pretty expected that people are looking for some risk on the labor market down the line, and a 50 basis point rate cut cannot be ruled out.
Dory, let me bring you in here as well. If we get that cut on Wednesday, Dory, and it's 25 like we expect, I'm curious how you think the stock market, Dory, responds and reacts, because there's been some commentary, including on the show, from folks who wonder, when that happens on Wednesday, if the Fed cuts like we expect it to, could that be a sell the news event, Dory? What do you think?
Well, I think it's pretty well already priced in to the stock market. The bigger question is, what happens to the 10-year? A year ago they cut the rates 50 basis points, and the 10-year went up 50 basis points, and that defies kind of what the whole administration is trying to accomplish here. So we got to watch that 10-year, and that's going to tell us a lot. And then the effect of that 10-year will have an effect on the stock market and the growth stocks, et cetera.
Gunit, that is right in your wheelhouse, so we're fortunate to have you. Let's talk about the benchmark 10-year. I'm looking at it, Gunit. It's we're at 4.038. Where do you think it heads, kind of near to intermediate term? And does that depend, Gunit, more on the Fed, or more on the inflation trajectory?
Yeah, I think a lot depends on how the Fed characterizes the rate cut. I think investors, if they think about this as a little bit more driven by political pressure, if they view this as one driven by a lot more focus on labor markets and less on inflation, I think the market will start to differentiate between what the Fed will do versus what the Fed should do. The front end of the yield curve is pricing what the Fed will do. The 10-year point, the 30-year point is much more likely to price what the Fed should do in the long term. Inflation risk premium can build, and we think the yield curve typically can steepen in a setup like this, which sends the long-term bond yields higher than where they are today.
Dory, does the stock market need a cut to move higher? It might want the cut, but does it depend on that cut for us to move higher into year end?
You just answered your own question. It does not need the cut to move higher. You've got double-digit earnings growth in the stock market this last quarter. We had a nice earnings beat. We're set up for doing that going forward. We're obviously concerned about tariff impacts and things like that, but the market's still pretty strong, and it's certainly got some room to run. A lot of people are worried about Mag 7 being overpriced, but it's not. It's probably underpriced given the core fundamentals of production, like stocks like NVIDIA. If anything's overpriced, it would be the rest of the S&P 500 as a whole. But there's whole sectors sort of like banking that are still in the 11 to 13 times forward PE. So there's plenty of room to run.
Is there, Dory, you talk about banks, is there a specific bank or two you'd be looking at?
I'm looking at all of them in general, but you remember they got a 500 basis point rate hike and squeezed a lot of margins, and they're still recovering from that, and margins are slowly expanding. A little cutting rate actually kind of helps them a little bit to lower their deposit costs immediately, to the extent those that control that. And that'll be a nice relief for the bank. So I think we might get a little bounce for some of them. Some like U.S. Bancorp, which is still trading at a pretty low PE and got a nice yield to it, looks pretty good, all the way down to some micro caps and some others.
One question, Gunit, I have for you. You know, we talk a lot about housing, Gunit, on the show, right? We talk a lot about the 30-year fix and affordability. I wouldn't be surprised, Gunit, if there's plenty of folks who are watching this right now, we're interested in buying a home, and they think, you know what, I'm going to hold off just a bit, maybe 6 months or 12 months, because, hey, I hear hot talk, the Fed's going to start cutting. Is that relationship between the Fed cutting and the 30-year fix that tight?
Yeah, I think it's a very non-traditional market. I think the long end has not reacted the way you would typically see it historically. I think this is the sort of risk of unintended consequences. If the Fed goes too fast too soon, the long end rates actually might end up being slightly higher in what we now call a twist steepening, a sort of a more aggressive form of steepening that people have not seen for quite some time. So I think that's the risk. If the Fed rate cuts are seen as credible, I think long end mortgage rates will come down. That's going to be a relief to the home market. But if not, then there's a risk it goes the other way.
Dory, you mentioned some opportunities you see. We talked about the great AI trade. We talked about the banks. What about small caps, Dory? If the economy's hanging in there, if the Fed's going to start cutting, do I want to carve out a position in those pint-sized companies?
Yeah, I think that makes some sense because the pricing on the money centers and the larger caps and the mid caps, they all go in unison and move up. And so the biggest value are on the smaller banks, and they're not any riskier and in some ways less riskier because a lot of them carry, pretty high capital ratios and are doing pretty good. A good example would be Texas Capital Bank here in Texas. Has got a forward PE of 11, and they run a very high capital ratio, about 25-30% higher than what JP Morgan has, and yet the growth prospects and the double-digit expansion of its earnings should give it a nice run going forward.
So Gunit, Dory's given us some very smart advice, as he always does, for equity investors. I'll get you out on this. For fixed income investors, Gunit, they're listening right now. They turn to you for guidance. What do you tell them?
Yeah, what we're telling our investors is, look, yield curve steepeners is still the right risk reward. There's a chance the economy is slowing down. If it is, then we think the Fed could follow up with a series of 50s. That could be a significant steepening of the yield curve. So we think yield curve steepeners are the best risk reward. Even though the trade looks pretty well positioned, one of the interesting aspects here is if investors think political pressure is really ramping up, we think the yield curve can steepen by another 100 basis points. So that's a big risk-reward trade, assuming the assumptions of political pressure play out.
All right, Gunit, Dory, thank you guys both for your time. Appreciate it.
Thank you.
We are just getting started here on Market Domination. Coming right up, could company quarterly earnings become a thing of the past for investors? President Trump has a suggestion for a new cadence. We'll tell you what that might mean for your investments. Plus, CoreWeave is getting a big boost to the tune of billions. We're going to explain why. And investors may be all aboard on Union Pacific as its outlook is on track for a win. We're going to have those stories and more when we return. President Trump posting on Truth Social on Monday and saying that companies should no longer be required to report their earnings on a quarterly basis. My next guest says it could be a double-edged sword. Joining me now is Matt Maley, Managing Director of Equity Strategies at Miller Tabak. Matt, it is good to see you. So the president suggested, okay, maybe companies no longer should offer earnings reports every quarter. Maybe it should be semi-annual. Two questions, Matt. One, why do you think Trump is saying this? And two, what is your response? What do you make of it?
Well, to a degree, part of it's why he's saying it is, this whole idea of deregulation and putting less of a burden on companies. And of course, he wants to, let people or companies be able to focus more on the longer term rather than just worry about every single quarter and what kind of an impact that will have on their on their stock's price and maybe their bonus or whatever it may happen to be. But the flip side, of course, is that as I said, it's a double-edged sword because we have less transparency for the individual investor. I mean, one of the things that the SEC is really tries to focus on, or certainly has over the decades, has been the individual investor. And so if we have this fewer time, I mean, the institutional investor, they have these company meetings, and you know, the big firms take these companies around to with their managements and meet with the institutional investor. The individual investor doesn't get that. So there's obviously a give and take there that could have some interesting impacts on the longer term.
It's interesting though, Matt, because listen, I've talked to any number of executives over the years, as I am sure you have as well, and you will hear this sort of complaint, Matt, about the kind of quarterly cadence and this idea that they'll say, listen, it encourages short-term thinking, it discourages long-term planning. Are you sensitive to that criticism?
Well, I am to a degree, Josh, but the problem is that if you have a real good management team, and so many of these companies do have good management teams, they don't care about the short term. I mean, they care about the intermediate and long term. And even though it does cause them to do a few things here and there, but well-run companies don't worry about that. And everybody has ups and downs. The economy obviously has cycles, and so any company will have the same. But you can ride through it, I think. And I just think that when we're talking about situations, the market's doing so well, up at all-time highs. Now we're worried about the Fed's independence. Now we're worried maybe about transparency with certain companies, especially ones that might be trying to hide something. It's not necessarily the best thing in the world, especially for the individual investor.
Let's game this out though, Matt, just hypothetical. Let's say CEOs did only report every 6 months. What would be some of the just practical, on-the-ground implications you think that could mean for the market?
Well, I mean, I guess the number one thing is, what are people willing to pay for the risks that they're taking? And if they're only getting something every 6 months, after having, getting them, 4 times a year, they're taking on more risk. Well, the stock market is expensive as it is today. Are they willing to take that risk? And it just, they'll talk about risk premium and things like that. It does raise some concerns in my mind, especially when you have a situation where so many things in the marketplace right now, anyway, that have, indicated that a top of some importance was around the corner, whether it be high valuations, huge leverage in the marketplace, tight credit spreads, what have you, high speculation, what have you. It's the type of thing that does concern me a little bit. I don't think it'll be a catalyst to cause for a major top to take place, but it is something that could pile on to that issue that people should be concerned about, to be honest with you.
Are there, Matt, are there any changes in how companies report you could get behind? For example, this conversation, it brought up this Jamie Dimon, Warren Buffett op-ed. I don't know if you remember, this was back in, I think it was 2018. And they talked about, Matt, how they were not in this op-ed, they were not opposed to quarterly earnings. They were not opposed to that quarterly cadence. They did emphasize their problem, though, Matt, with companies offering quarterly EPS guidance. They said that leads to an unhealthy focus on short-term profits at the expense of long-term strategy growth and sustainability. Do you agree with that?
I do, and actually wholeheartedly, because, one of the things is that we on Wall Street, I mean, that's what we're paid for, is to do that analysis, right? So, for the company to have to spoon feed the analysts all the time isn't necessarily what they need to be doing or should be doing. So I do agree with that. I mean, we'll have to work a little bit harder, but that's okay. That's what we're here to do. So, like anything else, there's good aspects to this proposal and ones that aren't so good. I think it's the end of the world if they start going to every six months. But those suggestions that Mr. Buffett and Mr. Dimon talk about, I think are good ones. It just makes Wall Street work a little harder, and there's nothing wrong with that.
Matt, always great to see you and to have you on the show. Thank you, sir.
Thanks a lot, Josh.
Now time for some of today's trending tickers. Yahoo Finance's Ali Canal. Join me now for a look at Texas Instruments. We're going to look at CoreWeave and maybe a little Union Pacific. We're going to start with Texas Instruments. Those shares sliding as China launches an anti-dumping investigation into analog integrated circuit chips. So this one, I mean, there was a few different chip headlines today, Alex. We had China saying NVIDIA violated anti-monopoly laws. That was after the acquisition of Mellanox. That was actually kind of a surprise announcement. I think, some reports noting, listen, trying to show some leverage here, trying to still some weight around with the tariff talks going on in Madrid. Then also, though, China did launch this anti-dumping investigation targeting, reports note, a kind of semiconductor made by American companies, and that did include Texas Instruments, and you saw the stock react.
Right, and Texas Instruments was named directly here in this anti-dumping probe. You're seeing those shares down around 3% in afternoon trading, and these are the chips that help power everyday electronics like smartphones, like cars. So these are very important in the chip ecosystem. And like you were saying, Josh, I mean, this adds to a lot of the tensions that we've been seeing between the U.S. and China as talks continue. The two sides still negotiating, still at that table. China is one of our largest trading partners, and investors have really been waiting for this deal to materialize. President Trump saying he will be meeting with Xi Jinping on Friday. We do have that deal with TikTok, which had a ramification across Wall Street as well, with Oracle shares rising on the heels of that news. But Texas Instruments, the stock has been struggling in general, down about 5% this year. We're trading about 20% below some of the highs that we saw earlier this summer. And management recently warned that chip demand isn't bouncing back as quickly as hoped. So even though we talk about the biggies like Nvidia, like some of those other chip makers, this is a sign that there are some companies out there that are struggling. And once again, China just seems to be at the core of a lot of these pain points for these chip companies.
For sure. All right, turn to CoreWeave. Let's look at that one as well, because those shares getting a lift as the company discloses an order worth at least $6.3 billion from NVIDIA. So this one, Allie, CoreWeave saying, okay, NVIDIA has agreed to buy cloud services valued at around $6 billion. This deal, it sounds like per reports, first announced April 2023, runs through 2032. CoreWeave was on the move today. Of course, this one we talk a lot about it. I mean, look at that move, 8%. It's nearly tripled, it looks like, since the IPO.
Over 200% since the IPO. You're seeing shares up 8% today. Like you were saying, this locks NVIDIA in as a guaranteed buyer of any of that unused cloud computing capacity through 2032. And that gives CoreWeave both the stability and the validation that they will have NVIDIA as a key partner here in this AI infrastructure race. Deutsche Bank also added the stock to its catalyst buy list, saying that demand for AI data centers still far outstrips supply. And that's something we've been hearing from a lot of Wall Street strategists over the past few weeks, the past few months, certainly after this latest earnings season, that narrative alive and well. CoreWeave went public earlier this year. And like Josh, you were just saying, I mean, the run up here has been astronomical. Definitely one of the hottest IPOs this year.
Most on the street now to hold on this one, in part perhaps because of that rocket ship of a run. All right, lastly, let's go to Union Pacific as Citi upgrades that one to buy, hiding more clarity on its merger with Norfolk Southern. So Citi likes this one, Allie. Risk reward too compelling to ignore on the railroad company. They talk about strong operating execution, which they say bodes well for Q3 earnings and the likelihood of integration success, assuming deal approval. Stock up about 0.5% it looked like.
Yeah, so the regulatory path forward for this merger with Norfolk Southern, less uncertain than it did before. This is the argument that Citi is making, boosting the odds of that approval. But even if the merger does not happen, Citi did say that the valuations look attractive at this point. It's trading at a discount compared to some of those peers and the broader S&P 500, while still continuing to execute operationally. You are seeing shares up modestly today. Year to date, we are down around 5%. So again, maybe some opportunities there for investors to get in at this lower valuation as we look across the railroad space and continue to track some of these mergers within this industry in general. And it seems like right now the odds of this merger going through, at least for the time being, they're rising, and that's being reflected in some of this optimism on Wall Street.
Yeah, stock in the red this year, but Citi says that is an opportunity. All right, thank you, Allie.
Of course.
Coming up, some hard plays from an expert on the best investments in the software sector. That story and a whole lot more when we return. Stick with us. Shares of Oracle, they're rising again. This coming amid continuing talks between the U.S. and China about TikTok and increasing investor appetite from the AI boom. We're navigating how to play the sector with the Yahoo Finance playbook. And joining me now, we got CT Panigrahi, Managing Director at Mizuho Americas. CT, it is good to see you. So I do want to start, CT, with Oracle, which is moving higher in today's trade. President Trump hints at a TikTok deal. A buyer has not been named, CT, but as you know, Oracle has been mentioned as a possible contender. Interested to get your thoughts there, CT, as a financial analyst who covers the name.
Yeah, thanks for having me here. Look, TikTok is one of the, I would say, the major customer in Oracle Cloud Infrastructure. It has been, in the news for some time. How is that going to play out if there's a ban on TikTok, if somebody buys it? Look, at this point, Oracle is kind of, they are hosting TikTok at this point. Any news would certainly impact, but so far, the way, news coming out right now, we don't see any kind of, major issue at this point until we see them losing TikTok as a customer.
I'm just curious, CT, how much of a topic of conversation is it, though? I mean, when you're talking with your clients about Oracle, how often do they bring this up?
Not this year anymore. Last year, yes, it was in the news. Mostly, remember, towards the November, December timeframe last year, there was a lot of discussion on TikTok. This year, I won't say, I haven't heard much discussion about TikTok.
So, CT, you look at this stock, it's in the green today. It's up around 80% this year. You argue, though, the risk reward here still attractive?
Yes, look, Oracle is now in a second phase of growth, I would say. Remember, if you go back to the last decade, 2010 to 2020, their top line 10 years CAGR was like 4%. But now if you look at from 2020 to 2030 with our forecast, it's going to be 20% plus. Now, Oracle has now become a growth story at this point. And what's fueling that is the AI. Oracle is now a structural winner. Now you're seeing mostly all the AI companies using Oracle as infrastructure. But the next phase for Oracle is when enterprises start adopting AI. Oracle has end-to-end stack, starting from applications where data get ingested to the database, the market-leading database. And then you have AI infrastructure and then agent platform. So you have the end-to-end stack for enterprises. So there is definitely a lot of opportunity for Oracle next few years.
Let me ask you, when you saw this journal article noting that OpenAI signed a contract with Oracle to purchase $300 billion in computing power over roughly 5 years, some skeptics might have looked at that, CT, and said, okay, that's great, but that is customer concentration risk. What do you say to that?
Look, I think Oracle secured one of the, I would say, the largest trailblazer for AI. OpenAI is driving the demand for AI. They're the trailblazer there, and I think it's very hard to replicate that kind of acquiring a customer, the largest AI company as your customer. But if you exclude that, let's say excluding OpenAI, Oracle growth or the revenue target that they set for fiscal 29 around last year, around this time, they set it for 104 billion, doubling from around 52 billion, in 5 years. But now, based the way they guided in last quarter, I think their number, even that 104 billion, will go further up. According to our estimate, probably it will be like 108 billion if you exclude OpenAI. And if you add OpenAI, it will be probably 168 billion. So it's a massive growth opportunity. So whether you think about OpenAI or exclude OpenAI, Oracle is now a growth story.
CT, so you like Oracle, you say that'll benefit from AI, the great mega trend. So too will Intuit, you say. I think their investor day is actually, I think it's Thursday, CT, correct me if I'm wrong. The stock is basically flat this year, roughly. What moves it higher?
Yeah, look, yes, you're right. Intuit is hosting their investors day on Thursday. Intuit is a dominant player in both small business and consumer in the tax business side. So there's a growth story, growth and margin expansion story. It had a good run recently, but until the last quarter result, fiscal Q4, I think investors are a little, skeptical about the growth given their conservative guidance. We see a significant opportunity for them. They usually start with the conservative guidance, and then they try to beat that number. And this Investors Day will be the right time where they will talk about different growth drivers as well as margin expansion opportunity there. So we see them as an AI beneficiary as well. In July, they introduced their AI agents, and which is included now in the subscription. Probably company will talk about how they are even going to monetize AI, introducing a separate SKUs. Remember, for small business, who they cannot hire someone to manage their back office, AI agent, I think, going to add a lot of value for them. So we think they're going to be an AI winner.
One last one, CT, I want to squeeze in here. Synopsys, that stock is well in the red this year, down nearly 15%. You say, though, that's a buying opportunity.
Yes. I mean, in the recent quarter, last week, they closed one of the largest deal in the history of Synopsys. They acquired Ansys, $35 billion acquisition. But in the quarter results, there is a weakness in their IP business. That kind of overshadowed that opportunity they're going to get in Ansys. I think, in a quarter or two, you'll see the benefit of Ansys acquisition. This IP weakness, yes, they saw one of their foundry customer moved some of their, opportunity in terms of revenue. So, but, next quarter onwards, when they guide their fiscal 26, we expect them to guide above current expectation. And then you will see next few years, Ansys growth opportunity will layer in on top of Synopsys.
CT, appreciate your time and those picks. Thank you.
Great to be here.
Coming up, Tesla stock is breaking out of a wedge, but with a rocky recent past, where will it go from here? Stick with us. A technical expert is breaking it all down. That story and more when we return from break. Tesla shares jumping as CEO Elon Musk is buying up $1 billion in shares. That stock now turned positive for the year. My next guest has been watching the charts on the stock, and he sees a possible breakout ahead. Join me now for a look at the key levels to watch. With Tesla is Fairlead Strategies Senior Technical Strategist Will Tamplin. Will, it is good to see you. So Tesla in the green. We've wiped out the year-to-date losses. We turn to you, Will, for that technical take. You look at the charts. What do you see ahead for Tesla, Will? Is this one going to keep moving higher?
Good afternoon. Thank you for having me. We do expect Tesla to keep moving higher. It pushed out of a triangle formation a few weeks back, and those patterns are typically bullish when they resolve to the upside. In this case, we do expect intermediate term upside follow through, and we can derive a price projection of around 500. And that's at the top of a long-term secular uptrend channel. That's really the next major resistance level on the chart. We have seen an acceleration in upside momentum after that triangle breakout. We saw some brief consolidation, but really late last week is when we saw the momentum pick up. For those that follow the MACD indicator, we've seen a positive divergence there to the upside. So everything in our work points to more upside follow through for Tesla, looking out a few months.
So, Will, let's say I'm watching this and, I'm looking for a pullback. Where would the pullback in the stock be where you would say that would be a smart place to get in?
Sure. So when we see gaps up like we saw today, they sometimes can be exhaustive, especially after a few days of upside that we've already seen. So today's low will mark the top of that gap, and then the bottom of the gap, which is near 396. If that gap fills pretty quickly, then that would indicate that there has been some exhaustion there, and we would expect some short-term digestion and profit taking. And if we see that short-term pullback, the next level for Tesla is around 362. That's from the May high. So a former resistance level now turned into support.
So you see this one moving higher. Well, where would you call out overbought territory? What would be the levels?
Sure. On our long-term metrics, we have a lot of room to overbought territory, and we have, support of those long-term trend following gauges, like a 200-day moving average, for instance. I think if we got up closer to the top of that channel near 500, we would start to see, more overbought extremes take place. An overbought condition isn't necessarily a bad thing. So once we see that overbought condition, a loss of momentum in response to that would be sort of the sell trigger, if you will.
You do know, Will, this one can be, fairly volatile. Is your point there just to make sure, listen, if you're going to move in, you've got to have the right stomach for it?
Yeah, definitely. In a name as high beta as Tesla, it can see outsized moves. in one way or the other. So you have to be careful, especially if you don't have an extreme risk tolerance. So our recommendation would just be to position size accordingly. If you are going to trade in and out of Tesla, and your risk tolerance is low, just make sure that the position is a relatively small portion of your portfolio.
In the time we have left, Will, let's broaden out this chat. You look at the SPX, the S&P 500. I'm just curious what you see, Will, as we head into this Fed meeting and longer term as we head into year end.
Sure. So going into the Fed meeting, we have an uptrend in place with no concerning sell signals. So positive momentum. We're watching as a risk metric the 20-day moving average. That indicator we find is helpful in strong momentum driven tapes like we're in right now. So a trend following gauge like the 20-day moving average, if that rolls over, that would be a sign that we would see potentially a more significant correction, more so than we've seen over the past several weeks. And then we're also watching support at the 50-day moving average. That's just below 6,400 on the S&P 500 as another risk metric. So if we get below that, then things would start to deteriorate from a momentum perspective as well. And in a stock like Tesla, going back there, that's another thing to keep in mind are these top-down influences, because if we see that SPX break down, then Tesla would likely Tesla would probably go down as well, if not more than the S&P 500. But for right now, the trend is still intact with the support of that 20-day going into the Fed meeting.
And finally, Will, we are watching Treasury yields closely too, of course. Walk me through what you see in the charts there.
Yeah, so we have some key levels in play going into the Fed meeting this week. So the 10-year Treasury yield has an important trend line support near 4%. So that's a key level in the 10-year yield that we're watching. It's a nice round number as well. If we saw a couple of weeks, if the 10-year spends a couple of weeks below that level, that would confirm a breakdown in our work. And it would suggest that a cyclical downtrend in yields has taken hold on the 10-year yield, I should say. And that would put next support at 367 as a downside objective there on the 10-year. We're also watching the 2-year, which has support near 3.5%. Same deal with that one. If it takes out that 3.5% level, that's a long-term level. So a breakdown there would suggest that another cyclical downtrend has a hold there, and secondary support on the 2-year is 3%.
Well, thank you so much for your time today. Appreciate it.
Thank you for having me.
Well, Stephen Miran, President Trump's nominee for a seat on the Federal Reserve Board, is on his way for a seat at the table with his confirmation vote set for tonight. This comes as the Federal Reserve gears up for its policy meeting Wednesday. But what do we know about the nominee? Fed correspondent Jennifer Schonberger has a closer look. Jen.
Good afternoon, Josh. Stephen Miran is the chairman of the President's Council of Economic Advisors. He served as an economic advisor to the Treasury Department under Steven Mnuchin during President Trump's first term. He was also a senior strategist at Hudson Bay Capital Management. Miran is credited as being one of the authors of Trump's tariff policy and a key architect of the president's economic agenda. He has also been linked with the push for the so-called Mar-a-Lago currency accord, based on a paper he wrote outlining various strategies for rebalancing U.S. trade and trying to counter overvaluation of the dollar. In a paper that he penned last March for the Manhattan Institute, Miran called for reforms to recalibrate the Fed's governance to insulate it from day-to-day politics. Specifically, he called for greater oversight by the president of the U.S. over the central bank, shortening Fed governors' current terms from 14 years, as well as imposing bans on what he calls a revolving door between the executive branch and the Fed. He, in fact, proposed that Fed members should be prohibited from serving in the executive branch for 4 years following the conclusion of their term at the Fed. But during his confirmation hearing before the Senate Banking Committee, Miran told lawmakers that if he were confirmed, he would act independently, but he would not resign from his current White House post as chair of the President's Council of Economic Advisors. Instead, he would take a leave of absence and then resume his role at the White House after the conclusion of his Fed term. This has greatly concerned Democrats who are worried about central bank independence. In fact, following that hearing, Democratic senators asked for Miran to resign if he was confirmed by the Senate, something that Miran told senators he was not prepared to do. And ahead of this evening's vote, the ranking member on the Senate Banking Committee, Senator Elizabeth Warren, sent another letter to Miran basically saying that he and President Trump deny that Americans are facing higher inflation, and asking for his reaction to the August Consumer Price Index, which shows that inflation is now around 3.1%. In that letter, Warren wrote, "Your reaction to the August CPI numbers will help inform lawmakers as they weigh their votes and evaluate whether you will truly be an independent voice on the Fed." Josh?
Jennifer, thank you. While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.